I have a lot of growth stocks in my portfolio, but I also have a pretty large collection of relatively high yield dividend and dividend growth stocks. As a matter of fact, there are four stocks that alone make up about 10% of my portfolio. I'm Jason Hall. This is Investing Unscripted, and I'm going to break down why I own them and why I think other investors might want to consider owning them as well. Before we dig into the details, though, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas than the four great companies I'm going to talk about next, you should go to my special link. You see it right there on the screen. It's fool.com/unscripted. If you go to that link, The Motley Fool is going to give you its 10 best stocks to buy right now. Combine it with the four stock ideas I'm going to give you right now. And that's 14 great stock ideas for you to help you get started on supercharging your own investing story. All right, let's get to it. I'm going to kick things off with Brookfield Infrastructure and Brookfield Renewable. I'm going to talk about these two separate entities a little bit together. You heard the name Brookfield, and yes, they are related. Brookfield Corporation, Brookfield Asset Management, Brookfield Infrastructure, Brookfield Renewable, Brookfield Reinsurance, Brookfield Business Partners. These are all related companies under the Brookfield family umbrella. So these two particular, you see it on the screen, what I've highlighted is how well they've done since about 2010, going back a pretty long ways, give a good idea of the total returns. The blue line, that's the S&P 500 since 2010. Been a great run, up almost 535%. But both Brookfield Infrastructure and Brookfield Renewable have managed to deliver better returns for investors over that period of time through a combination of acquiring more assets, growing the base of their business, growing the cash flows, and raising their sizable dividends that they pay to investors along the way. Now, I do want to highlight one of the reasons that I'm really compelled to talk about these companies right now is if you look at their more recent performance, again, the blue, that's the S&P 500, they're both actually down from where they were 3 years ago. And you look at a 5-year return, and they've both underperformed the S&P 500. I'll talk a little bit about why that's the case before we move on to the next stock after we talk about these two. But I do want to spend a minute and explain what these two different businesses are. And we'll start with Brookfield Infrastructure. So Brookfield Infrastructure is just that. It owns infrastructure assets, things like regulated power transmission lines, commercial distribution of electricity and other utility services. So think about things like clean fresh water and wastewater. Has a lot of transportation businesses from things like toll roads and rails, the actual rails, and different kinds of terminals. So think about like a port terminal on the water, other kinds of storage terminals for other different kinds of goods as well. Has really moved a lot more into the midstream space of the energy industry. So that's like the infrastructure for storing and moving things like natural gas and oil and refined products around. They've really substantially moved into that business over the past 5 years. And data is a big growing part of their business as well. The modern global infrastructure. So things like data centers, they've started stepping into that. They have some big partnerships with some big players in the data center space and also data transmission. So things like 5G towers, cell towers, fiber optics, something that they moved in. So they have this large base of assets. The value of that is, again, these are kind of the hidden things that we all rely on every single day, whether it's for commerce, transportation, communication, or energy. They're so incredibly important to the global economy. Let's move over to Brookfield Renewable. So the business started off a number of years ago as a bit of a risk reward play on hydroelectric. The company, starting with Brookfield Asset Management, Brookfield Corporation, now its parent company, saw an opportunity to acquire some hydroelectric power facilities in Latin America at extremely cheap prices. A lot of the market was scared off because of the geopolitical concerns, but it was a brilliant value move that has absolutely paid dividends in really big ways. Since then, they've applied some of that same playbook to wind, solar, and other opportunities in renewable energy. We've seen them acquire assets out of companies that were bankrupting, perfectly good, high-quality assets that generate great cash flows. They were able to acquire from companies that made missteps in other areas. Their solar business and a big part of their wind business is a big part of that. Key is that these assets, thinking about like Brookfield Infrastructure, with those critical assets that make the global economy work, that make global society work, we've continued to see the same thing with renewable energy. The assets that they own produce power and they sell it on these long-term contracts, 10, 20 plus years that makes them really, really valuable cash flow engines. All right, I'm going to exit the screen share here, talk a little bit about why I'm such a big fan of the Brookfield businesses. Number one, Brookfield Infrastructure, Brookfield Renewable, the tailwinds are great. We're going to continue to see trillions of dollars, trillions with a T, flow into infrastructure and flow into renewable energy around the world in coming decades as the world becomes more modern, as we see the low cost, improved technology of renewables, particularly with compared with storage, take on more and more of the world's power production. We need more infrastructure as the global middle class expands. We need to modernize the infrastructure in a lot of the West, where we have electric infrastructure, water infrastructure that's been around for a century. So there's a massive opportunity as those assets, the asset bases expand, and as we modernize that infrastructure. The Brookfield family of entities, there's one thing that they all have in common. It's incredible skill at capital allocation. You need the people running a business, not just to have great tailwinds and great opportunities, but the people that are making the decisions about where to invest the money, they need to be really good at finding opportunities for return. And the Brookfield entities have been really good at that. That's why I own Brookfield Renewable and Brookfield Infrastructure. Let's shift gears a little bit. I want to talk about the REIT, the Real Estate Investment Trust, that I own the most of, and that is EPR Properties. Now, I'm going to start with EPR Properties' long-term dividend yield. And at recent prices, the dividend yield's about 8.2% compared to the long-term average of about 7.2%. And I think that there is the potential that right now is a good opportunity to be buying this dividend stock. Now, there's a caveat here. I think this is really important to mention. This is not just a dividend growth story. It is clear that at different times in the company's history, this is during the financial crisis, they had a little bit of a misstep in the early 2010s, and then this is during the pandemic. Companies had to cut its dividend multiple times in the past before returning to dividend growth. And I really feel like now is one of these periods, not one of these periods here, where we saw a prior dividend cut. Now, I'm going to highlight a couple of things that I think are really valuable that separate the company. This is both the theater business. This is the biggest part of the business right now that creates some risk, but it's also, I think, the one that's most misunderstood. It generates around 37 or 38% of base rents right now. So by far, it's the largest segment of this experiential retail-focused business. That's not great because the theater business is in decline. It started to recover, but it's still way off of levels we saw back in 2019. But what's most misunderstood is how strong EPR's base of theater business is in. EPR owns about 3% of North American theaters, and that 3% of North American theaters that they own generate 8% of the North American box office. So basically, all of EPR's theaters are in the top half of box office for the entire country. In other words, they're really important theaters for its theater operators. So it has really valuable, in other words, it owns the ones that are worth the most. Even with that said, they realize the long-term trends are not favorable. They're looking to reduce their exposure there and increase the exposure in other areas of experiential real estate where there are opportunities. Now, I want to highlight the balance sheet because there is certainly concern that it maybe has too much debt, and its ability to grow in these other areas where it sees opportunity might be challenged because of a weak balance sheet. And I don't necessarily think that's the case. Fitch, S&P, and Moody's, the ratings agencies, they think that its debt load is fine and reasonable and even very high quality. It has an investment grade credit rating from all three of those agencies. That says a lot about their ability to manage the debt. We've also seen that their ratios, their coverage ratios, are quite reasonable. Also, their ability to service the debt's pretty good. They have around $2 billion in debt, a little more than $2 billion. A small amount maturing this year that they're going to have to roll over. And then you start looking at 2025. Again, they don't have a big lump of any of their debt maturing at any one given time. And it's also either fixed rate for the most part or hedged in a way that they're pretty locked into low rates. So a lot of things to like about their balance sheet. So I think the concerns about EPR's balance sheet and its exposure to the theater industry are largely misplaced. Yes, there is some risk there, but I think the risk-reward profile for EPR is really attractive. That's why it's the REIT that I own the most of right now. Okay, friends, I owe you one more stock. We're going to jump into the tech industry. We're going to talk about the semiconductor industry with Texas Instruments. And what I'm showing you here, this goes back to 2003. So the chart that I'm sharing right here goes back to 2003. This is roughly when Rich Templeton, who was the CEO for most of the past 2 decades and is now the chairman of the board took over the company. And the bottom line is that TI is number one, it's benefited from the growth in demand for semiconductors, but also through Rich Templeton's incredible leadership over that period, allocating capital well, getting really great returns, and absolutely trouncing the market over that period of time. Now, more recently, the stock hasn't done great. I mean, it's still generally outperformed the S&P 500, but more recently the stock just hasn't done great. Not only over the past 3 years has it underperformed the S&P 500, but we've seen a lot of other semiconductor stocks do incredibly, incredibly well. Now, why do I think now is still a good time to be owning and thinking about even buying more Texas Instruments? That's because the growth in demand for semiconductors is on the rise. And this is the absolute leader in analog semiconductors. So think about things like power chips. Every electronic device needs power. So you can't just have a great AI chip or a great microprocessor. You have to get power to it. You have to manage that power. You also have to get the signal out of it. And these analog semiconductors are how electronic devices communicate with the real world. Texas Instruments is a big player in the industrial semiconductor space too. And that cycle has been off as much as we've seen the demand for AI chips really lift a lot of the semiconductor space. Industrial demand and weakness from like EVs and the automotive industry broadly has put it in a bit of a cyclical downturn. Now, that's corresponded to some big investments that Texas Instruments has been making so that it can continue riding the wave of long-term growth. And what's happening right now is they're deploying all this money to increase capacity, some other things that are going to lower their production costs so that over the next few years, they can benefit from what's expected to be about a 35% increase in semiconductor units shipped. So they're positioning the business for that next leg up of growth and also to give them even more cost advantages as they increase their scale, drive out costs through larger formats for making their semiconductors, a lot of smart things that they have in the works right now. Okay, so those are my those are four of my largest dividend stocks that I own. Three of them are high yield. All four of them are dividend growth stocks. Three of them are high yield. Three of the four are very much dividend growth stocks. And I think they can have a good spot in any investor's portfolio.